Yes. So, namaste everyone. Hello everyone, and very good morning. Welcome to your first surprise YouTube live session. And thanks a lot to everybody for joining in. And trust me, guys, today we are going to be deep diving into one of the most important topics of your PM subject. And trust me, it is one of the most loved as well as hated topic of PM subject by the students as well. So the topic which is there on my screen, divisional performance measurement and transfer pricing. It is one of the most popular, one of the most underrated, one of the most, I think, frequently tested topic in your exams. So keep your energy levels high and all the josh high for the session today. Now, well, as I can see, let me just see who have joined in. So, yes, so I can see definitely students have joined in like from Delhi. I can see from an international number as well. So I think people are joining in from the different spheres. I know because it is one of the most popular, one of the most integral topic of PM. Okay, so we will be discussing this in detail. Now, one thing first, okay, the first thing first, which is very important, guys, if you're joining this live for the first time today, you have to hit the subscribe channel. Why? This will not only help me to grow, but guys, trust me, the ROI that you will get on this subscription will fetch you more benefits than the other investments that you are doing. So trusting on the same and going by this, hit the subscribe button and we are good to go. Correct? Now, a quick one before we start. Just to make you more understanding, just to create your more understanding about this topic, people, what happens is, before we begin with any of the topics, important is that you have to understand the depth of that topic. Okay, then why the topic holds such a crucial value even for you, for your exams and for your practical life after you become ACC as well. Because what happens when you work in real companies, yes, when you're in that real working environment, no, things are not that goody, because the managers, the divisional managers, they get their bonuses, they get their appraisals, they get their increments based on the ROIs, based on the RIs, residual income. So many times what happens, the manager hits bullseye, they're hitting every target, but still they're not able to get the desired bonus. And because of which, they do some decisions, they take some decisions which are terrible for the company. Yes, which are terrible for the company, even though it may do good to them. But for a company overall, it's terrible. So I can see that, let's say there are two managers, they're playing a game and both of them win the game. Nobody's losing. Who is losing? The head office. So in this chapter today that we are going to cover up, we will be looking at the pictures both from manager's point of view, the company point of view, do a lot of question, and we are also going to do a lot of such understandings just to understand that how examiner, they love testing this conflict. Yeah, the conflict that arises between the managers, between the organization, how the examiners love testing you on that. We will be discussing those areas as well. So we will be covering in today's session in detail. We'll be covering the residual income, we'll be covering the ROIs, we'll be covering the divisional performances like the transfer pricing, which is, like I said, the most loved conflicting topic by the examiner. So keeping your energies high, keeping your calculations high with the calculators. No, don't keep them aside. I would need it frequently because we'll have lots of questions, loads of topic understanding that we will be doing today. Okay, so all of you be with me, begin with me, and we are discussing this topic live in the class. So, everybody, I need you to be having your super energies, your super, what do you call, calculation speed while we are discussing this topic. Okay. So now everybody settle in. Now let's begin. So look at my screen. Your eyes should always be on my screen only. Now, divisional performance, measurement and transfer pricing that we are discussing. So let's discuss the first thing first. Here comes the first point. The first point is in this topic, ma'am, decentralization. What is decentralization? Decentralization means I have my own company and I am the boss here. I take all decisions. I do all the day in day out duties and I am the boss here. But then as my business grows, for me to handle this business alone becomes very challenging. So I hire more people and of course with responsibility comes authority. So I give some responsibilities to them. At the same time, I give them some powers, some authorities. So this is the way that I am controlling the company, not by myself, but with a team of people. So when you are extending your team and even giving more powers, distributing more powers, giving more responsibilities, this is where decentralization comes in place. So decentralization is nothing but decentralization is you are delegating your authorities, you are distributing your responsibilities among a lot of fellow people, among the staff, among the different managers with the core purpose that the work in the organization should grow, the work in the organization should go more quicker, decision making becomes more quicker, more better as you are growing. Okay, so we know that entity we always look at as a whole. And so far, in all the questions that we have done so far, you have, even in the variances, we took the company as a whole and we practically never looked into departments. In this topic today, we will be deep diving and looking in detail the departments. Okay, so we will see the department's performance. Now let's see a company has four divisions: Division A, Division B, Division C, and Division D. Overall, as a company, it's doing terrific. But division wise, two divisions are doing great, two divisions are simply terrible. So we need to assign those responsibilities on those divisional managers. We need to have their performance evaluations done, right? So people, for that, this concept of decentralization, divisionalization comes in place. Okay. So now here, let's take an example. Let's say I talk about Reliance Industries. Now it has got different divisions like petroleum, clothing, food, entertainment. Further, when I break down this petroleum, I say it's got diesel with different grades. It's got natural gas, it's got petroleum. Okay, now the divisions, which is like here NZ division, diesel division, EZ diesel division, SZ division, the division natural gas, petroleum. Now, instead of looking at Reliance Industries as a whole, let's look down at each division. Let's look at the divisional performances. So comes the question, ma'am, we need to have some benchmarks, like against which we will compare the performance. So you will compare the performance against which topic? Okay, you will compare the performance against not topic but against which yardstick. So we will compare the performances against these two terms, which is ROI and RI. So for every division we will see what is the ROI, what is the RI. Okay, and according to which even the divisional managers will take their decisions and the company as a whole will assess the performance of divisional managers. But as we go deep dive into this topic, I will tell you that but is it sufficient to take the performance evaluation based on RI and ROI only, or do we need to go more into some other areas as well? Okay. So now, simply speaking, decentralization would mean that we create independent or autonomous divisions, units to decentralize authority and responsibility, like we discussed. Now, the next point, ma'am, what are divisions, and how do we distribute or how do we create multiple divisions? What is the criteria? So for this, your costings have helped you. Okay, so now here, what is the criteria that we will use to understand the different type of divisions? Okay, or to distribute a company into various types of divisions, right? I hope everybody is with me here. Any questions, any queries, feel free to ask me, guys. Okay, now let's discuss about the term that comes with decentralization, which is cost centers. Cost centers or profit centers or revenue centers that we are going to be discussing are basically the criteria based on which we divide the divisions or we categorize a particular division into. Okay, and remember, it is the first trap that your examiner will set you into. Yes, it is a trap that your examiner will set you into, because they will be giving you a scenario in the exam, right? They will be giving you a scenario in the exam, and then they will leave you there. It's like a maze, and you have to identify, it will click which center. Will it be a cost center? Will it be a profit center? Will it be a revenue center? Or will it be an investment center? Yeah. So it is going to be a very interesting trap that your examiner will love to set you in. Okay. So now, so what are the different centers or what are the different categories that a division can be classified into? Your division can be classified into categories like, just confirm me somebody, am I visible properly? Okay, 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 okay. Thank you so much. Yes. Now, how do we divide these different centers into? So we divide these different centers into cost centers, profit centers, revenue centers. Actually, I will put revenue first. Revenue centers, Yeah, then profit centers and then investment centers. Okay, now um, a very simple way that what are cost centers. So now here if I say that what are cost centers, simple way I think the most simplest way I can put up is a cost center is a center where the manager will have no control over profit, no control over sales. Yes, no control, no involvement in generating sales, no involvement in controlling the profits. So if I say manager is a cost center manager and we evaluate his performance based on the profit earned by that division or earned by that company, will it be a fair way? No. And on the same side, if a manager is a revenue manager and I say, boss, cost in the countries, the cost in your division has been like super high, okay, or your the cost in your company has been super high, you are going to be penalized for it because you have not been able to control the cost. But the manager will say, boss, I don't have control over cost. I only have control over revenue. So why do you want to penalize me for the same? That's wrong. So therefore, I always say it's a trap that your examiner will set you into. You have to identify clearly in the question whether it's a profit center or cost center or a revenue center or an investment center. Okay, now I think before I even take up any other examples or any other questions, I can popularly take one case study. And that case study I will be taking of the famous Taj hotels. Yeah, that we all love to stay in. Come back from Taj, everybody, and let's be on this page. So I am taking the example of Taj group of hotels. Okay, now here, let's try to understand for Taj group of hotels, what can be the different cost centers, what can be the different profit centers, what can be the different revenue centers as well as investment centers. So what is, and you know that Taj group is a very, very big group of hotel and that has got a head office, that has got different branches, that has got different divisions and different departments. So then mapping each department or each division to a particular category would be a better advice, right? Now here, what can be the different cost centers? So I think I can give you one example. One of the cost center that we can discuss here is, guys, even answers given by you would be much, much welcome here. So one of the cost center can be for the hotel. I think the biggest cost center is their kitchen, right? So kitchen department, or even I think I can say housekeeping, because these are the major cost contributors for a hotel. Now, when I say is a kitchen department, then the head of that kitchen department, which is generally the head chef, would be responsible for the cost which is getting incurred, like the fruits, vegetables, groceries, ingredients, all those costs, the staff cost, the wastages that takes place in the kitchen, the food wastage, the time wastage, and so he would always have control over these, right? So if I am the performance evaluator, I am the person from the management and I have to evaluate his performance. I would like to evaluate his performance on the expenses which are incurred in the kitchen, like the wastages that have taken place, like the staff costs which are employed in that kitchen area, like the items, the groceries, the vegetables, fruits, all that are incurred in that kitchen area. Correct? I would be making him responsible for the same. But when I say that, look, you are being responsible because the number of guests in the company, in the hotel have reduced. Okay, the rooms getting booked for the guests have reduced. Do you think the head chef would really be into it? Do you think that it is right to penalize him for the same? Absolutely not. Because he will say, boss, it's not my KPA. It is not my cup of tea. I make tea. I don't drink this tea. Right? So you would say that no, it's not my area. Don't penalize me for the same. So to evaluate head chef performance, based on the number of guest rooms booked is wrong. But to evaluate his performances based on these cost variances would be the most appropriate way. So if the head chef is analyzed or is assessed based on the profits, unfair, revenue, unfair, based on cost controls, correct measure. Clear? Now let's take another example, and that is for a revenue center. What can be the revenue center in, let's say, the Taj hotels? The revenue center, I think, can be your sales team. For every organization, it's their sales team, right? So, like we have the sales team and the ones that are doing reservations in the hotel. Now, for them, what is their KPA? Their KPA is that they have to ensure maximum bookings and maximize the revenue, correct? They would want to do maximum bookings and maximize the revenue. Now, if we say, if we measure their performances based on the room occupancies, based on the number of bookings in the peak seasons, based on the room rents that have got slashed, okay, due to the, or that have got increased due to the peak season and the demand of the hotel, it is a fair basis. But if we measure the performance of these sales team people based on the cost being multifold times increased for housekeeping, it is not justifiable. But if we measure their performances based on the losses that the company, the Taj hotel may have, gone into, or this particular hotel has gone into, is unfair, because they can only maximize revenue, but they cannot control cost. Correct. So they have to be only assessed for their performances relating to the revenue that they have made, the orders that they have generated, the bookings that have been taking place, reservations that they have done, the room occupancies that have taken place. Done? Now, let's go to the third example as well. Okay, let's take the third example as well. The third example is on profit center. Or the third category is profit center. So let's again take an example. When it comes to Taj hotels, what is the profit center here? Profit center here will not be the individual department, then will be particular hotel branch. For example, Agra branch, for example, Delhi branch, for example, Mumbai branch, for example, Andaman Nicobar branch, for example, Dubai branch. So you have these branches, right, scattered all around the world. So when you assess the performance of a particular hotel, of a particular branch, that becomes a profit center, because their cost control activities will be there, revenue generation will be there. And what you need for profit side, boss? You need revenue, you need cost. Both you're getting for that hotel. So that hotel branch now becomes a profit center. The performance evaluation will be done of that hotel branch. Clear? So we will be then assessing the performance of that hotel branch manager based on the profits that have generated, based on the margins that have been created, rather than deep diving into every cost area or every revenue area. We will only go in deeper into that area which has got the most adverse variances probably, or even the most favorable ones also, just to ensure that the calculations are done well, or what the standards were set low. Okay, so I hope we are able to understand how do we assess the performances of a cost manager, of a revenue manager, of a profit manager. Now the fourth one, that is assessing the performances for an investment center. Now what can be an investment center? Have you ever worked for a company? So when you work, you know that when there are multiple divisions, the decisions like where to do investments, the decisions like how much to do investments in plant and machinery, how to do investment of the idle funds is generally not taken by any hotel branch, is generally not taken by any hotel division, but it's taken by the head office, correct? But it's taken by the corporate office, right? So there comes this role of hotel division, or there comes the role of the entire group. Okay, so now here if you ask that, ma'am, how do we assess the performance as an investment center? It will be the entire hotel group, or Probably, let's say the Taj group is like a very big group scattered into different zones, different divisions. So instead of taking the entire Taj group, we can assess the performance of particular region, right? Like the northern region, the southern region, the eastern region, the western region, the Indian subcontinent, the Dubai and the other areas. So we can, on different categories, we can assess the performance of the manager. And when we assess, so here it's entire hotel, no, hotel branch, sorry. Okay, now it's investment center. So investment center is, like I said, about, either looking into the entire hotel group or um, regional divisions, right? So this can be the investment manager. Now, how do you assess the performance of investment manager? Because profit centers, you assess the performance based on profit margins. So you can have different ratios that you can use to assess the performance of a profit manager. For a revenue manager, we did the performance evaluations based on the sales generation. So based on sales growth percentages, we can evaluate his performance. The cost center, based on the cost variances. Right? Based on the cost variances, we assessed his performance. And on what criteria or on what basis we can assess the performance of an investment manager? That we can do on the basis of ROIs or RIs. Okay, return on investment or return or residual income. These are the most popular basis based on which we measure the performance of the manager who are responsible to look into the investments of the companies, right? Who are responsible for the investments that are being made by that particular branch, particular region, not branch wise, the particular region, particular, zones or the entire group. And then we calculate ROIs and RIs just to understand whether the manager's performance, like the divisions that they're handling, are they generating the desired returns or not. And based on which even they take decisions that whether further investments will be made in a particular project A or in a particular project B. So here comes the role of ROI and RI. And that's, I think, the entire picture that is in front of you. Because based on ROI and RI, which is one of the most popular topics for you in the exam, probably the divisional manager can decide like to invest $50 million in a particular project or not. Okay. So I think we can summarize this center-wise theory into that as we move from a cost center to a revenue center to a profit center to a probably an investment center, I think we can understand that the manager's areas, the manager's control areas gets expanded, right? With cost, with revenue, they are able to control or they are able to be answerable for profits that are being generated. Finally, with the combination of investments, the investment center is becomes their area. So it's simply the expansion of control that is taking place, right? So even just probably as a thumb rule that I can give you for examination purposes, please note it down that examiners will test you always, again and again, always, always, only on controllabilities. So only on controllabilities will be the area where examiners will test you like frequently. And it is the only area which they will test you for these topics. So it's only about controllability. So with controllability, remember this term controllability, because we will be using the term controllable at various places while we are discussing ROI and RI. Okay, I hope it's like heads up from you all and it's absolutely crystal clear from all of you watching this video or watching this class live right now. Now, in order to be an efficient manager, in order to ensure that the performance evaluation of the managers meets their expectations as well as the organization's expectations, what do we need? We need a perfect goal congruence. And how do we achieve goal congruence? Goal congruence means what? Goal congruence means your goal and my goal are together. Okay, you want to get a global ACCA rank. I want you to achieve a global ACCA rank. We are having goal congruence. Okay, so this is what for an organization also it will look like. Now, how can we achieve goal congruence in an organization? So it's like there are two divisional managers. Okay, and they are playing cricket. One is doing batting and other one is doing bowling. And at the end of the match, both the team won. Right? Both the managers won. But ironically, the organization lost. The losses were borne by the organization. Why? And how did it happen? Organization was the one who was doing fielding all the time and they ended up losing. Yes, because both the managers they did their individual good, they achieved their individual divisional targets, but when it came to achieve the center targets, the targets for the organization as a whole, this is where the terrible thing happened, and they made terrible decisions which were not resulting in goal congruence. Why? Because they took those investments, they did investments in those projects that brought a very high ROI for their divisions. But they lose those projects that even though were not generating very high ROI for them, but it was generating fairly good ROI for the organization. But they lost it. They left it just because they did not want their divisions to show a negative result. High disadvantage of ROI. Yes, it's a big disadvantage because ROI leads to sometimes managers making those decisions which are not goal congruent or which are not benefitable for the organization as a whole. So there comes the role that or the managers need to make practical decisions. Yes, managers need to be more practical and they need to make decisions which is probably, not entirely based on the ROIs, not entirely based on their own good, but for the organization good as well. But like we say, why managers are doing this? Why? Because the management only told them, now look, you are a profit manager. You control profit. We will assess your performance on the profits. You are an investment manager, right? You are controlling that particular division. We will assess your performance based on ROI. So when his performance is based truly on profits, truly on the ROIs, see, genuinely, he would be more interested into that his divisional performance should not go down. Otherwise, he would be penalized. His bonuses will go down, increments will go down, his performance evaluation will go down, and nobody wants it. Why do you join a good company to get good bonus, good increments, good career growth? If that is not there, then boss, what are you doing there? You're not selling peanuts over there. Correct? Yes. So, I think that's fairly understood. So goal congruence is definitely, and with that is relatable that long-term and short-term objectives of the organization should also be achieved. See, with ROI, what we are really looking into is not long-term objectives. We are looking into short-term objectives, no? That let's say this year's ROI target should be met. Let's not care about what will happen in the future. Right now, I'm bothered about that my yearly target should be met. My annual performances should be evaluated very high. So what ROI is making you look into is short-term targets and not long-term targets. And that's an inheritance limitation of ROI. That they would always make you look into the short-term objectives rather than the long-term objectives. Right? So probably looking into it, I think becomes a very, very difficult point for the managers to take decisions. Okay, so I can briefly say that when it comes to ROI, that when you know a division is able to control their investments, whether the investments are into machineries, are into working capital, are into different projects, are into different assets, how do we exactly judge that whether the investments is doing really good for the division or not? For that we use ROI factor. For that we use RI factor. Okay. But again, like we discussed, it will immediately give you a dysfunctional problem. So this is a very hot favorite examiner area also in the exam. Why do you think ROI gives you, or ROI ends up having dysfunctional decisions? Okay, because I think I can give you a very simple example. Let's say a divisional ROI is around 20%, and there a project comes in that offers them an ROI of 15%. Okay, your divisional ROI is, let's say, here I've given that example. Your divisional ROI is, let's say, 10%. The overall organization average ROI is 7%. A new project comes in and that offers ROI to the division at 8%. Do you think the manager will go for it? I don't think yes. Because managers know that their annual performances will be based on the ROI that they have been able to maintain for the division. Have they been able to maintain, or will they be able to maintain the divisional ROI of 10% if they take this project with 8% ROI? No, not at all. Because their ROI will go down then if they go for a lower ROI project. So what they will do, what divisional manager will say, boss, no, I will not accept it. I will not accept it because it will drag down my own percentage. That's like digging my own grave. Why would I do it? I will not drag down my own percentage below 10%. So I'll simply reject that project and I will go for some other project. Okay, but if you see, it's a flaw with ROI, not with the manager. Why? Because the ROI criteria method is making the divisional manager to go with the project that only offers them either their divisional ROI or beyond it, but not go for a project that will offer them ROI below it, even if it is better for the organization. Right? And so what will this lead to? This will lead to the managers rejecting very good projects. Okay, and yes, the goal congruence gets affected you. Like here, the entity would, as a overall, would like for the manager to go for it because overall entity's ROI is increasing, but the division's own ROI reducing. So nobody would like to hit the spade on your own foot, right? So this will not be affected, right? So this one I created just now. Right, now to fix ROI problem, we need to have a solution, right? Because there is a solution for everything. So to fix this problem, we have a solution in the form of RI. Residual income is giving you that solution. How does it fix this problem, and how does it give you this problem and this solution? So let's just see. Right now we just understand the background. I'm not doing any calculations. I am giving you a background understanding that you need for the different complexities that can come up in the exam, and you will be completely ready for it. Okay, now if you observe here, ROI gives you the results in percentages. And based on the percentage, you accept the project, you reject it. Correct? But what if I say that we give the, there is a factor known as RI, residual income, that gives you the results in absolute terms or absolute figures. So here you'll have a figure like excess profit of 10,000, excess profit of 20,000. Now, when I have a figure, when I don't have a percentage, I don't have anything to compare with, because for comparisons, we need percentages, right? So now if a divisional manager has got a project that offers them an extra profit of 20,000, will it look fancy to them? Will it look attractive to them? Yes. Will they accept the project? Highly likely they will accept it. ROI says don't accept it, but RI will say, boss, accept it. It's giving you positive figures. So the loophole that ROI had is getting covered by RI, residual income. That says what is the income remaining after you have considered the interest, expense, and everything. How much profits are you still left with if you go ahead with that project? 20,000 positive, take it. Take that project. What will this lead to? Divisional managers, the important or the good projects that they were leaving because ROI criteria was not met, now they were accepted because RI says go for it, it's giving you positive income. Good for the company, good for the managers, good for everybody. But now here, the mindset of management also needs to be changed. That they should not be assessing the manager's performance only based on RI. Okay, they have to take multiple factors, even non-financial factors, like the efforts given by the managers, the conversions that they are doing of the orders. So they should consider these non-financial factors as well to assess the performance of the managers, right? So then here probably once they go for RI, they will never have that approach, oh, it is dragging down my percentage. So that drag down percentage mindset will change for the managers as well. Combination of RI and ROI is like the bang on perfect combination for the organization. Done. We are done with the divisional performance measurement. Yes, now we'll just be looking into transfer pricing. That topic is over. But formulas are remaining that we will do. Questions we will do towards the end. So I is glued on my screen. Yes, don't take it away when for a 30 seconds also. Your eyes have to be glued on my screen. Now, everybody look down. Look on my screen, please. Yeah, so we have discussed about ROI broadly. We have discussed about RI also broadly. Now we will be discussing them more in detail and doing more questions. Okay, with the term ROI and RI, before I take up any other point, I think I can take up quick questions, right? Quick question. So what is the simple formula that I can give for ROI? Okay, the simple formula that I can give you for ROI is like in the ratios also that we cover, right? The simple formula that you have studied probably everywhere in your syllabus. So that is ROI can be measured as the formula that you will be using will be profit before interest and tax divided by capital employed multiplied by 100. Okay, so that is what you are just assessing the return based, generated by the capital invested. So what is the return generated? It's always before interest and tax. So PBIT divided by capital employed multiplied by 100, you get your ROI. Done, dusted. Yes, you got your ROI. Yes, absolutely. Okay, now how do we calculate the ROI? No, RI. So ROI is clear. PBIT divided by capital employed multiplied by 100, you get your ROI. Hands up for it. Good. Now let's calculate how do we do RI calculation, residual income. Like I said, it's not in percentage. Like I said, it's only the absolute figures that you have it. So what is residual income? Residual income is simply representing the wealth which is created by the division. We've already discussed it, right? The wealth which is created by the division, by the department, by the region, by the company, for whatever you are calculating ROI and RI for that entity. Okay, it shows how much of the profit is remaining after the adjustment of notional cost of capital. Why notional? Because we always take the cost of capital that is applicable for that particular project that we are looking into. Even though you have not paid that cost, right, you are still assessing that what is a tentative finance cost, interest cost that will be going towards that project. Okay, so we adjust that notional cost and then we look at what is the profit figure that we are left with. Is it positive or negative? Positive, go for it. Negative, leave it. Simple and steady. Okay, now how do we calculate RI? So the RI is calculated as divisional profit of a division less the notional cost of capital. How do we calculate notional cost of capital? So it will be divisional profit. And which profit do we take here? We always take profit before interest and tax. Okay, profit before interest and tax. Less. You will take notional cost of capital. How would you calculate it? Capital employed. That is, what is the capital that you have invested into, multiplied by the rate of cost of capital. Okay, multiplied by the rate of cost of capital. That will be given to you. You just have to multiply and calculate. Nowhere in the exam you're required to calculate the cost. You're never required to calculate the percentage. Yeah. So that was a typical statistics thing that is not there in PM. We are not here evaluating the performance. We are not here evaluating the performance of students based on the formulas, how well you are able to apply, but based on the evaluations, how well you are able to do. So examiner wants good evaluators. Examiner wants somebody who is good in decision making, not somebody who is doing the calculations. Was that can be done by the computer system also when you become ACCA. So evaluation is something that you need to be having, bang on. You need to be bang on that. Yes. Right, so I hope my class is with me, everybody is with me, and you are enjoying your ROI and RI. So today only, what you will do is, you will look into your investments that you have made, including the investment of subscribing to the channel today, and see which investment is giving you higher ROI, which investment is giving you that positive feed, positive inputs. So that is positive RI. Go for that investment and stay with it. Okay. Now going further, comes two more important terms that we have to be absolutely thorough and clear with, and that is traceable profits and controllable profits. Okay, controllable profits and traceable profits. What is it? See, we have been discussing today that the manager's performance should be evaluated on the profits that they can control, right? It should be evaluated on the profits that they're able to control. So that is what we call as controllable profit. For example, head office has incurred a huge expenses and it is allocated it to the department or to the division, not department, to that particular division. Should a divisional manager be pinpointed for the very high head office expenses allocated to him or to his division? That would be unfair, right? That will be like simply unfair. You are studying PM and I question you for FM. Unfair. Correct? So on the same lines, this is also unfair for the divisional manager. So how should he be assessed on? Okay, should he be assessed on the entire profit or only on profits calculated by having the revenue and the cost that he is able to manage, that he is able to handle, that he is able to control? Of course, he should only be assessed for the cost, for the revenue, for the expenses that he is able to control, not something that is like come as a gift to him by the head office. Right, so that is simply not his KPA. You are studying PM right now with me and I say that, boss, why you did not complete your chapter in FM? So that is out of the syllabus for me, right? On the same line, that's out of syllabus for him. Why he should be tested for the same, right? You and your sibling are there. You both siblings are there. You are studying at home and your other sibling is still at, roaming around and while it's very late at night. Your parents come and question you and they scold you. Boss, tell me why your brother is out still. Why he hasn't returned back? And you say, what should I do with him? I am studying at home. You are not appraising me. Rather, you are asking me why he is out. Is that your KPA? No. Is that your area that you're controlling? No. Should you be penalized for the same? No. Clear? Yes. Remember it. Remember it always. Okay. Continuing with the same, guys. Okay, so now we clearly understand about the controllable profits, right? That the profits that simply says that managers' performance should be assessed on the basis of the areas, on the basis of the cost, revenue, that they're able to control, that they're able to be managing, that they're able to be questioned for. Next term that comes up is traceable profit. Now there's a difference between controllable and traceable. Okay, controllable and traceable. I hope you are able to, have my audios absolutely clear. Just put up in the chat box, please. Just type in so that I am pretty sure that my audios are going and they are being heard properly the way that I want you to be hearing it. Okay, now before I take up the example of traceable profit, I think we can just, yeah, before I explain you the traceable profit, let's take a quick example. Okay, now, you and your best friend, you both are sharing room in a hotel. Okay, in a hostel. Forget about hotel. Let's take hostel. So you and your best friend are roommates in the hostel. And for this month, the electricity bill has come like super duper high. Now your parents wants to understand who is really the one at fault, you or your roommate. Okay, so this is the situation which is there in front of you. Now, how will we come to know? Now let's say you are the one who studies late, who studies till late because you're a very dedicated ACCA student. And once your studies are over, you play game also. And by the time you sleep, it becomes 3 a.m. Okay. Now here, your friend is already slept. You are controlling the electricity post he sleeps. You are controlling the switch, you are controlling the remote, you are controlling everything. So for this time limit, probably you are the one who is responsible. So this is your controllable area, correct? But, okay, but let's say you have the hostel Wi-Fi router. Okay, the hostel Wi-Fi router rent bill comes to you. Now that this room is shared between you and your friend, correct? See, when you were awake, that time the AC that you used, the TV that you watched, your probably any OTT on, the laptop that you were using, the games that you were playing in, that was your controllable area. But Wi-Fi is being used by both of you in the same way. So this is not something that you're controlling, but that is getting traced to you directly as a part of your hotel, as a part of your hostel bill, because it's not you who's deciding, that how much Wi-Fi will be used by you or your partner. You're not able to control it. You're not able to control it. Okay. Rather, you are not able to control the cost of Wi-Fi also, because that Wi-Fi cost is already prefixed, pre-decided, and that's just coming as a part of the bill to you. So it is something, it is a cost that is belonging to your room. It is a cost that is belonging to you and your friend. But is it controllable by both of you? No. Is it traceable to you? Yes. So this cost is traced to you. But is it controlled by you? No. The TV at night controlled by you. Wi-Fi not controlled by you. So Wi-Fi cost is a traceable cost. That laptop, TV, AC cost is a controllable cost. Next time you switch on your TV, AC, remember it's a cost that you are controlling. Okay, and use your Wi-Fi like endlessly, because that's not something that you're controlling. So cost will still be incurred whether you do use Wi-Fi or you don't use a Wi-Fi. Correct? So it's a traceable cost. Correct? Now, how do we define a traceable cost? These are the profits or those areas or the areas of cost and revenues that can be directly traced to a division. May not be directly controlled by the manager, but it is directly traceable to a division. Clear? Right? So I hope you are clear. Everybody, you're with me on this. We will quickly understand what is the difference between a controllable profit and traceable profit with the probably with the formulas. Okay, with the formula. So I think we can have some more examples to understand this. Like when manager is paying to his team overtime, that's his controllable cost because that's his choice of paying the team overtime, right? Now, head office rent has been allocated to the division. That's not a controllable cost for the manager, but that's a traceable cost. Why? Because this is a cost traced into the division's profit, traced into the division cost. Correct? So that is a traceable cost. And when, okay, like even for head office expenses, there are head office rent that has been traced to the division. It is based on the floor area that they are using. But their general head office expenses, that is not traceable to the division also, because that's just a general cost that has been allocated to the division. So general head office expenses will not be a controllable cost, will not be a traceable cost. Why? You cannot trace it directly that, okay, this cost is specifically for this division. No, it's a general cost that is a part of the pool of costs, and a share of it has been given to all divisions, not on basis of any specific criteria. So it's not a traceable cost. It's not a controllable cost. It is not a cost that you will be assessing your manager's performance only, whether on a traceable profit basis or on a controllable profit basis. Clear? Right? Okay, so let's just quickly take these formulas and then we will discuss more pointers. Now, how do we calculate the division's performance, for the manager based on the controllable profit approach? You will have controllable profit for the division, and with this, when you add uncontrollable profit for the division, that is the cost directly traced to the division, which is uncontrollable for the manager. Okay, and it is directly traced to the division. So like I gave you the example, head office rent. Okay, remember that example, head office rent. So you will have traceable profit of the division. Now with this, when we add the unallocated head office profit or cost, which is generally the general cost or the profit, which has not got any specific criteria, when you add to the traceable profit, you will get divisional profit. So what is the chain? The chain is that you have controllable profit. With this, when you add traceable head office expenses, you get traceable profit. With this, when you add uncontrollable and untraceable, directly untraceable head office expenses, you get divisional profit. So this is the chain that you cannot afford to miss. Remember it. Okay. Now how do we calculate the formulas? So return on investment, as we have already started and we already know about it, friends, it is the division or the entity's return earned on the investment in the capital employed, right? Entities profits, entities return, and the division's return that they earn on the investments that they have made. So what is the ROI formula? Like we discussed, PBIT divided by capital employed multiplied by 100. And if we have to assess the manager's performance, we will take it controllable profit. Okay, don't forget this, very important. To assess a manager's performance evaluation, take controllable profits. Okay, that is controllable PBIT, controllable capital employed. That formula multiplied by 100. When we assess the divisional performance, you will never directly take divisional profits. Very important. You will never directly take divisional profit. Then, ma'am, what we will take, you will always take traceable profit first. So while we assess the performance of a divisional manager, we will be assessing his performance for the entire division based on the profits that we can trace to that division. Traceable divisional profits. Okay, rather than the entire divisional profits. So be absolutely thorough with what? Controllable profit, traceable profit, divisional profit. Done and dusted. When do you accept the project? When your ROI gives you the return more than the cost of capital. A manager will generally look into ROI, which is more higher ROI, and that probably that project is giving them the ROI beyond the ROI of their division, existing ROI. So it should be equal to it or beyond it, but it should never be below it. Otherwise, they will not accept it. Okay. Okay, now I take up the next one. So we have done ROI. We will now discuss RI, residual income. How do we discuss it? So like we discussed, residual income simply represents the wealth which is created by the division or that entity. And we will accept the project once your RI gives you a positive figure beyond zero. ROI is expressed in percentage form. RI is expressed in absolute numbers. What is the advantage and disadvantage of it? See, ROI can be used for comparative analysis because it's percentage form. And RI cannot be used for comparative analysis, but it can give you a better decision. Because if my RI is positive, I will accept that project. If my RI is negative, I will reject it. For ROI, criteria changes only when the new project gives you ROI beyond your current ROI or equal to it. Only then you will accept it, even if it is benefitable for the organization. But then also we will make this terrible decision of not going ahead with it. Okay. Now, so it is your residual income shows how much is the profit remaining after the adjustment of notional cost of capital on the capital employed. You will take or you will accept the project if your RI, residual income, gives you or is more than residual income, gives you this reflection. How would you calculate it? You would take manager's controllable profit on the same lines. For assessing manager's performance, take controllable profit. Okay, less your cost of capital multiplied by capital employed. And this cost of capital is known as notional cost of capital or imputed cost of capital. Why? Because we are taking the figure which is considering all the market inflations, all the deflations, inflations, increases, everything is considered here. So this decision we are taking before we are accepting the project. Since we have not already paid that cost, we are taking the notional cost concept here. Simple. If your controllable profit remaining is more than the cost that you have calculated, then accept the project. Negative, reject the project. Done. That's all. That's all for RI that you have to do. Next for RI is divisional performance. Boss, how would you assess the divisional performance for a manager? So for assessing the divisional performance, we will take into account the traceable profits. You know what is traceable profits, right? Same formula. Traceable profit less cost of capital multiplied by cost the capital employed. If it is positive, accept it. If it is negative, reject it. Clear? Now sometimes your question will say assess the divisional profit based on the total divisional profits and not traceable or controllable. Then also apply the same formula. Done. Okay. Any questions and queries so far? I hope you're absolutely thorough with RI with ROI. Now with the book that I've created, now quickly let's just have few advantages and disadvantages discussed here. Because it is your hot favorite topic. I told you it's a trap that your examiner will always set you in. And you have to decide a project should be accepted or not. That gives you 2 on 2. So never lose a single mark, because who knows it well, then somebody who's stuck at 48 and 49. Don't be that in that zone. Okay, now few advantages of ROI, people. It will, since you do the calculations in percentages, it will make your comparisons between divisions more easier to calculate. Okay, and it highlights the importance of capital efficiently, how well you efficiently utilize the capital, and it encourages managers also to reduce unnecessary investments, because sometimes not every investment will be fruitful for the company and for the division, right? So it encourages managers, do not invest in everything. So you come to me, you say, man, please invest in my company. The other person comes to me and says, man, you do investment with me. Third person says, you do investment with me. Instead of doing investment in all three, I prefer to do investment with you only. Yes, I trust you. So I will do investment there, and I would like to maximize my amounts, right? Now, what are the disadvantages of ROI? I think the most disadvantages, goal congruence can be affected. And very important, one more major disadvantage, for capital employed calculations, we generally take the values. What value should we take? Should we take the carrying value? Should we take the historical cost? Should we take the replacement cost? Should we take the least cost? What value should we take? It becomes a very questionable point. Although you are taking book values, but then is it the correct approach to take? Question mark. So very important is the calculation only. Okay, now, like I said, goal congruences can be a problem, because because the managers may end up taking decisions not favorable for the entity. Third, since we take ROI, and ROI takes into account depreciation also, right? And that is completely a book entry, but that can affect your ROI. So for example, your end year 1 ROI is 18.75%. Why? Because your depreciation is 20,000. So we took 15,000 divided by, you take capital, you will reduce the depreciation of 20,000 from there. Correct? Now the second year, what happens? Your depreciation increases. Okay, your depreciation increases. It becomes 40,000 cumulative. Third year, your depreciation becomes 60,000. So just think, from the same capital, if you are having 100,000, 100,000, 100,000, you are reducing more. First year, you reduce 20 for depreciation. Second year, because balance sheet, you reduce cumulative figure, right? Second year, you reduce 40. Third year, you reduced 60. So the same capital is now reported as 80,000 here. In the third year, the same capital is reported as 40,000. And due to which your ROI is increasing. But practically, is this increasing? Practically, is it increasing? No. So then, don't you think it's giving you figures which are dysfunctional, or the figures which are manipulating? Absolutely. So this is a major disadvantage with ROI, that manipulations can definitely take place by the managers. Okay, so here there is a great risk of window dressing. Okay, great risk of window dressing. Sometimes there is a very good project that you can take, but if I take this project, my capital employed will increase, so my ROI will reduce. I don't want it, I reject that project. So these kind of window dressing activities can be taken up by the manager. Very important theory part. which I'm sure now you have hold of. Now let's go to RI. The major disadvantage of RI is that you will not, just leave everything. You get a positive figure, you will accept it. So the dysfunctional behavior gets reduced, right? High chances of managers rejecting a project becomes reduced here. Yes. Now, and the best part is the notional cost of capital that we take always considers the risk. So you always consider the risk adjusted cost of capital. So it is not that something suddenly will come up and affect your RI. It will not take place. Disadvantage, the advantages of ROI. Take that as a disadvantage. Number one, like for ROI also capital employed disadvantage will continue with RI. But the major disadvantage of RI is, boss, you cannot do comparisons. Why? You are not expressing them in percentage. You are expressing them in absolute figures. So comparison becomes very, very misleading here, right? And here again, you will have a potential for window dressing because manipulation of capital employed will take place. Clear? Any questions or queries so far? Put up in the chat box. Absolutely 100% clarity I need from all of you. Okay, now let's move on. Let's move on to, I think, the most critical and the most complex topics of your entire PM syllabus. I always read this topic as number one in complexity, which is transfer pricing. Now, how do we understand this topic? So let's take an example. Okay, do you like samosas? That's famous Indian eatery food item. I mean, I personally like it. Do you like samosas, all of you? You will say, ma'am, don't talk about samosas. Right now, we are doing the class, and you make us think of samosas, and we will go in a different zone altogether. Correct. Now, come back, my friends, and let's take a simple example. Okay, now just imagine this, that you and your sibling, okay, you and your sibling are having two shops inside the same house. You are running the samosa shop and you are selling them at the front gate to the customers who are, going through, passing by and all that. And let me tell you, you make some lovely, yummy samosas. I mean, superb samosas. Yes. And you are selling it at the main gate to the actual customers. Okay. Now, you charge a price of 50. You charge a price of 50. Okay. And you are in fact so smart that you even charge your sibling. Uh, okay, let's put it this way, that you are charging your sibling a price of 50 for samosas to buy. You say that, boss, if you want to buy the samosas from me, you need to pay me $50 for it. Okay, and let's say 50 rupees for it. Let's keep it nominal. 50 rupees for it. And of course, your sibling is very furious. He says, boss, what is it? You are charging such high price from me, your brother, your sister, and we are staying in the same house and you're charging such high price from me. And that's like a clear loot. Okay, that's like a clear robbery, a daylight robbery that you're doing. From outside, I can buy it at 20 rupees. You are selling it to me in the same house at 50 rupees. Right? That's a daylight robbery. And your friend says that. And you say that, boss, it's my business, my shop. What's your problem? I'll charge the price that I find fine. Good. Right? And you say that I will charge 50 rupees only. Not less, not more. Right? So you both siblings are into a fight. Now who is the owner of the house? Mom. Obviously, mom. Mom says, boss, I am the owner of the house. And actually, mom is going to referee the entire situation, the most complex situations ever. And the most funny part is the trouble is between the two kids, the two, you can say the two, her own two kids, right? And even though they are neglecting this fact that the money, whether they charge 50, 30, is going to remain in the same house. And if you are charging high price to your sibling will go out to the market, buy the 20 rupees samosa and eat it. While if you would have charged the nominal or correct price for the same, then he would have taken samosa from you, ingredients inside the house, price inside the house, cost inside the house, money inside the house. But who is going to think so big? So mom has to play all these referee thing, right? So now here, guys, welcome to the transfer pricing topic, where the two divisions of the same company are going to be always arguing, fighting over an internal price. Okay, and it's the head office that will play the mommy thing. Yeah, that will play the mommy thing here. And somehow those two divisions, they always forget that the money will actually not leave the company if you do a correct pricing. And this is where your transfer pricing and the entire chapter or the entire topic of transfer pricing is only based on this scenario. Yes, siblings, mom, the same scenario. Now here, so now here is the test that will generally trick you in the exam scenarios. Okay, and then generally it gets tricky is, see, from the company's point of view, it really would not matter. From the mom's point of view, it really would not matter whether you charge 20 for a samosa or you charge 50 for a samosa, because you know, 50 is coming into the same pocket of the house and 50 is going out from the house only. So 50 is coming in, 50 is going out, and everything is happening in the same house. So money is actually not going anywhere. So for mom, it really does not matter. For a company head office, it really does not matter. But you know what matters is, for every division, it's their bonus, it's their performance, it's their profits. You know, it is that which is, you know, which is depending on the figure at which they are buying or selling, even if it is done internally. So for divisions individually, it really matters a lot. It really matters a lot, right? It would really affect their profitability, their bonus, their increments, I mean, all those calculations. For them, this tricky, this, you know, transfer pricing becomes a very, very important decision criteria. You know, it's like playing the good cop, bad cop. Playing the good company, doing something good for the company, or doing something good for the division. So it is that conflict which is always going to be there in exam also. So here we will be understanding the different ways by which a price can be set which will be good for divisions, which will be good for the company. Mom at peace, siblings at peace, everybody is at peace. That decisions we will be looking into. Okay, so I can even put it up that way. The transfer pricing cases, even the Vodafone case in India, it was a very famous transfer pricing case. The Idea case, very famous transfer pricing case. So transfer pricing cases are so real, and in real world, they're like so conflicts. So much conflicts arise between even the multinationals that they're always fighting with the government departments only for the same. So here in real cases, it's actually the tax authorities of different companies, the different countries that play that mom thing, that refereeing thing between the two multinational companies that are conflict. So who is going to be the referee here? The government department. Which government department? The tax government department. Yeah, the tax departments. Okay, so suddenly uh, the pricing of samosa that you're doing, no, it will look like as if you're doing a pricing for some like what, like you are doing a pricing of maybe Apple versus Irish. I love Irish. No, yeah, Apple versus UK tax, Apple versus Irish tax, Vodafone versus Indian tax. Those situations will come. So transfer pricing is one of the most practically tested topic that you will always have in your exams, in your practical scenarios. So never forget this example of siblings and the mom. And next time when you fight with your sibling over a decision, remember it's internal pricings that matter a lot. Internal decisions that matter a lot. Okay, remember that. Okay, now, so let's take this topic into more detail. So the different methods that have been discussed as per your costing methodologies, that can be a good transfer price we are discussing here. Okay, that can be a good transfer price. So how do we discuss it? Number one, the first method is the most genuine, is the most real method, and that's I think the most the most regular method, and which is market price method. That simply says, boss, let's not be at conflict. What price you're selling to the customer, I will buy at that price. So everybody is at no gain, no loss, right? They are indifferent. Because for them it doesn't matter whether you buy internally or you buy externally. It's the same price that you're charging. So both divisions would be ready to buy unless the buying division can really find any other vendor which can sell them at a price lower than this. But for the company as a whole, now it will not be much beneficial, because it is really not making a difference whether you're selling to a third party or you're selling internally, right? So it would be more beneficial when you are actually in that zone, whether internally it's more beneficial. So keep this as a main headline for transfer pricing topic. Transfer pricing decision should be such that it favors or it benefits both divisions and the company as a whole. Okay, now next method is full cost method. Full cost method simply says, selling division says, boss, I will sell you at full cost. I will not add margin. Buying divisions is ready to buy. See, buying division would be much ready to buy because profits are not there added. But he will also, the buying division, it will compare the full cost price with the market price that they're getting from a third vendor, right? From an external supplier. If they are getting a good price from the external supplier, then they may reject this full cost also. But do you think the selling division will be like very happy to sell it at this price? Not really, because the margins they are missing out. So if they are having good customer demand, they may just go for external sales rather than internal sales. Correct? Now next is marginal costing approach. Marginal costing approach is a very popular approach for your exam. Why? Marginal costing means you are just covering the variable cost. Who? The selling division. So it is basically the price where you are just covering the variable cost, and that is the price at which selling division will sell to the buying division. For buying division, it's like icing on the cake. They would be like, boss, give me all the material that you have. Why? I will not get this price outside the market. Outside, I will never get this price externally. It's the simplest reason because My vendors, there will be no vendors who will be selling at such lower price. So buying division will be very, very happy to buy. But will the selling division be happy to sell? They will only be ready to sell. I will not say happy to sell. Because when you're just covering the variable cost, they will only be ready to sell when they have lot of spare capacity and when the external demand is less. So as it is, their capacity is getting wasted. So as a company overall, yes, it will be very happy to have this price, right? Because then the products will remain internally and they're getting rooted here, right? So instead of incurring extra cost by the buying division, it's getting settled by the selling division. But it will only take place when there is spare capacity. When there is no spare capacity, there is no incentive to sell, right? For the selling division. Why would you sell only by covering your marginal cost? It's kind of a loss making thing that they're doing, right? So only when they have too much of spare capacity, they will go for it. Otherwise, they will not. Now, the same lines, full cost plus margin method. Selling division will be very happy to sell because they are getting their margins also collected, right? Buying division will only be ready to buy at this price only when it is lower than the external price offered. Only then they will go. But otherwise, why would they pay the division, the cost, the margin, everything if it is more than the price which is charged by the external vendors, right? Now, on the same lines, variable cost plus margin, I think it's a better approach, right? It's got some incentive for the selling division, so then they will be ready to sell at this price. But then for the buying division, again, they will compare it with the market price. Okay. Now, the next cost, which is like a Hitler cost. Yeah, it's a cost that can only be imposed by Hitler. What is that cost? HO directed cost. HO says that's a mom's cost. Okay, both siblings fighting. Mom says, boss, stop it now. What I say, that you have to do. I am the referee here. Tax department says, I am the referee here. We will tell you both companies will do that pricing. So they give a cost, no, both divisions should be ready to accept. Will they ready to be accepting that cost? They will say, no, why would I accept your cost? So it is a Hitler cost. Remember it like that. Okay, it will make your managers, it will make the managers feel very demotivated. They'll be like, okay, we're good for nothing. We cannot fix the price also. They will be feeling very, very disconnected, very, very demotivated because they will feel that, look, my independence is lost here. Now I am not independent to take my decision, so I will not go for it. They will generally not be ready to go for this price because it is not first their discussed price. Second, they will be demotivated, disconnected, and they will feel we are dependent on the head office. We're not independent. And that feeling of not independent can be better understood by all of you, right? I think we all have that feeling. No? If we don't feel independent, we don't feel connected. So that's the problem that will come up. Okay, now next is the most important. How many V's can I add here? Very important. It's the most important topic here that we need to be having hold of. Yes, and it is going to be there in the exam, guys. Don't lose your 5 marks for this. It is going to be there in the exam. So what is that topic? All of you be with me. Let's do one thing. Before I take up this topic here, before I take up this topic here, let's have a 30 seconds break. Yes. Let's have a 30 seconds break, guys, before I take up this topic. So let's meet in exact 30 seconds. Don't miss this topic. Yes. Okay, so we are back. We are back. Okay, now let me take screen to make you understand this. Guys, you remember this example that we took? I think it looks like a samosa only, no? So this entire concept will be understood with one samosa. Yes. You remember that samosa example that we were discussing when you two siblings had a fight and mom had to be a referee and they said no 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 you guys cannot fight, right? So now mom is at highly furious level. Yeah, mom is highly furious now. Why? You both siblings are fighting over the price. Right? Mom says the right step in. I will not tell you the price that you have to fix, but I will guide you the price that you should be fixing. So now here I have two persons. One is a seller, that is a selling sibling, which is you who is selling the samosa, and one is the buyer, the sibling who is buying the samosa. Remember, right? Your sibling who is buying the samosa. Now, you wanted to sell at $50. Your brother wants to buy at $20. And so again, your conflicts happen. Now, mom finally steps in and says, "Boss, it's enough. It's enough." You know mom's anger, right? Everybody knows mom anger. So now they say, "Boss, it's enough. Okay, enough of you have what you have been fighting through. Now there has to be rule. And now I will tell you to set up a price which is more fairer to both of you. Which is fairer to both of you, and we will not just take any random number. We will take the help of a formula to calculate. So now mom turns out to you first. Mom loves you more, so mom turns out to you as a seller. Right? You are the one who's a seller, mom turns out to you. So now mom says, what is the price that you should be charging? Let me guide you for it. Okay, you should charge at least that price that you need to make the samosa. Like you need to have flour, right? Atta. You need to have water. You need to have spices. You need gas. You need oil and all that. So if you calculate it, what is the cost that you need minimum to make that samosa? Okay, or I would say, what is that cost that you will incur to make the samosa? What is that? Let's say you see that the cost is $10 for me to make the samosa, to make it. But then, you were selling this one samosa to your neighbor. But because your sibling stepped in to know, you have to give that samosa to your sibling. So how much you're losing? How much you're losing for not giving it to your neighbor, right? How much the profit that you're losing? You will say, ma'am, mama, I'm losing the profit of at least $5. No, I am losing the profit of at least $15 profit. Okay, now mom says add them too. What is the price that you get? 25. So mom says seller, like you are not going to sell at a price which is lower than this. So what exactly is this price? If I convert it into formula, what is this price? It is the minimum price below which your seller will not sell. What is it? It is the variable cost, or we call it as marginal cost. Okay, the cost to make that product plus opportunity cost. Okay, what is opportunity cost? Opportunity cost is the cost that you have gone ahead with the next best alternative, right? You have not taken the the probably the cost in question, the option that you have gone for the next best, or you have not gone with the next best alternative, not gone. So because of which you're losing a notional contribution, and that is opportunity cost. So here even I think I can put it this way also. By discussing this minimum price, your mom taught you about the ACCA PM. See, your moms are so intelligent. But anyway, let's just continue with it. So I think, even when we put it this way, we can say that the minimum transfer price a selling division would be ready to charge, or would be the price below which they will not be ready to sell, will be the price what it costs to make that product plus what you gave up. What you gave up to sell it internally rather than selling it outside. So what you gave up, right? And that giving up is your opportunity cost. Clear? But just understand. Now I will just take you to situations for opportunity cost, because understand that your examiners will always make you trick around, will always make you stick around or stuck around this opportunity cost concept only. So what you have to do is only get hold of it. Opportunity cost is giving up. Be very kind and good, and you're just giving up the best opportunity that you had for earning, and now you're going for selling it internally, so you're losing up that opportunity. But there can be two situations, understand. Now let's say you have a line of customers for buying samosas outside your shop, and then if you're giving and you're not producing anything more, you're working at full capacity, and then you are, instead of selling it to a third customer, you are giving that one samosa to your sibling. Clear? What you're losing there? You are losing like that 15 pound dollars that we just discussed here. You're losing that $15 earnings that you could have done by selling it to the customer externally, right? So your opportunity cost here becomes 50. But let's take second example. You have just have startup of making samosas, and you don't have line or queue of customers outside, but you made a lot of samosas in anticipation. So now you think, boss, as it is, my samosas will be wasted, right? There's no takers much in the market. So as it is, they're getting wasted. So instead of getting them wasted, let me give it to my brother. At least he will be like, very, very indebted to me and very, very grateful to me that I gave him that samosa. Now, do you have any opportunity cost to lose in case of spare capacity? No, because you're not losing any opportunity. It's just that you are giving up that samosa because you don't want it to be wasted anyways. Anyways, you would have thrown it into dustbin, right? So instead of throwing it over there, you're giving it to your brother. Remember it like that. So now, here I can put up that if for opportunity cost, when there is spare capacity, there is no opportunity cost. And when there is full capacity, and you have to give away that one samosa that you were giving to your neighbor, and you have to give to your internally your siblings, then is there opportunity cost? Yes, because you lost on an opportunity. No, opportunity cost is nothing but just understand what you lost. Okay, what you gave up is your opportunity cost. Your examiners will always give you clue in the exam. It will never be like, hide and seek. No, it will be clearly given to you as a clue in the exam whether the entity or whether that, that division is working at full capacity or at spare capacity. And this sentence only will tell you whether opportunity cost will be considered or will not be considered. How much of it will be considered, that we are discussing now. Okay, so to get the basics of your transfer pricing questions correct, always look for that correct understanding of opportunity cost. Very, very, very important in the exam. Okay, so remember that samosas example and you will never ever forget it. Now, we forgot about the buyer, right? Now the other sibling turns it to your brother, and the brother says, Mom, you've been always protecting this brother only, right? You love him more, I know that. So you're always protecting this seller brother. What about me? Do you want that I should be paying like 200? Because he will charge what he wants to. So do you think that he will charge 200? So I should be ready to pay 200? No. And or because I'm too lazy to go in the market. So do you want me to be end up paying 200? You don't love me. Mom says, no, beta. I'm not partial between the two. So here comes the point for the buyer. Mom says, buyer, you need to know your maximum price beyond which you will not be ready to pay. Yes, beyond which you will not be paying. So what is the maximum price? So what is the maximum price that the buyer will be ready to pay? What do you think? Market price? I know one answer can be that the maximum price would be the external price at which the product can be secured, right? The external price at which the product can be bought. But we do a comparison here, okay? We do a comparison here. We calculate, now here comes one more understanding that how exactly do we calculate the maximum price. First is, if there is a market existing, of course, we will have external purchase price that we will take, okay? Or we will compare it with what is the price at which it will be sold by buyer to third party less its own cost. What does it mean? Let's say the external price at which your sibling buyer can buy it from the market is $20, right? But then what he is going to do, he is very smart. He's going to sell it to his friend. He's also got that seller brain, no? So he buys at 20 and he'll be selling it to his friend at 40. But for that, he will have to travel to his friend's place and that will cost him a petrol of $3. So $3 is incurred, selling it 40. What is the net selling price he's enjoying? 37, right? Net selling price he's enjoying is 40 minus 3, 37. How? 40 is the price at which he will sell it to his friend. 3 is the cost that he incurred to go to his friend's place. So he is having a net cost of 37 here. Here he would buy the product at 20. So what is the maximum price that he would be ready to pay? Maximum price. He should be ready to pay 20 or he should be ready to pay 37. Okay, the maximum price that he would be ready to pay would be the lower of the two. So he would be ready to pay maximum of $20 only here. He would not be ready to pay for 37 because lower of the two is 20. Clear? I will take this concept again and then if you have any queries and doubts, please tell me. But let me just give you a quick recap of what we have just covered in transfer pricing. Transfer pricing concept, especially the opportunity cost says, please check are you working at full capacity or spare capacity. If it is spare capacity, life is simple. Your transfer price is the marginal cost. But what if you're working at full capacity? Then in that case, your transfer price would be, you will check what is the minimum price at which your selling division would be ready to sell. And what is the maximum price at which your buying division will be ready to sell, ready to buy. Your transfer price will be in between the two. Yes, you will not give a final price. You will give a range of price that your price should fall between this and this range, minimum and maximum price, so that it is benefitable for organization and for divisions. Got it? Now, what is minimum price? Let's have a recap. Minimum price for a selling division is the price below which they cannot sell. And what is that price? That price is marginal cost plus opportunity cost. Opportunity cost of giving up that opportunity, of losing that opportunity, losing that contribution. Okay, so you will take what contribution you have lost. You will take the number of hours that you need to put in for the buying division. Sometimes, situations will be like, when you make for a customer, you need 2 hours. When you make for a buyer, you will need 3 hours. And contribution you're losing is actually 10. So you will not multiply 10 with 2, but you will multiply 10 with 3. Logical, no? Because your buyer needs 3 hours, internal buyer. So 3 hours multiplied by contribution that you are losing, 10 per hour. 10 into 3, 30 will be then your opportunity cost. Okay. Now, what is the maximum price that your buying division will be ready to pay, beyond which they will not go, boss? In any case, they will not go. It is the lower of the price that they can buy this particular material from an external buyer, or the price at which they're selling to the customer less the cost that they are incurring. So lower of the two becomes the maximum price. And I think it's more easy to calculate from the buyer's point of view, right? But I think enough of the formulas. Now let's quickly go into the questions and understand all the topics that we have covered so far absolutely fine and fairly. I will just repeat the formula from your exam point of view. So opportunity cost, that is, sorry, for minimum pricing for a selling division will be variable cost plus hours to be taken to produce the product to be transferred to buying division. So you will always take the number of hours that buying division requires multiplied by contribution that you are losing for the current product. So you will take contribution per hour that you're losing because you're not selling to your customer, multiplied by number of hours that buying division will require. Logical. And when we see the maximum price, it is the lower of external price at which buying division can buy from a third party, or the net selling price at which the buying division will sell to its customer. Whichever is lower, that we will take. So let's look at questions, and we will do questions on minimum and maximum price as well. Eyes on my screen. Let's do some multiple questions here. Okay, let's do some random questions. Okay, so I'm doing question number 2. Everybody take out your calculators. We're doing these questions now. Okay, let's do them. First question. Brenda and Eddie. Okay, Brenda and Eddie own 2 franchises in different parts of town and want to monitor the performance of the 2 managers who have made different levels of investments. So we are assessing the performance of these managers. Which of the following statements would explain why profit or ROI would be more equitable for comparing Branda's and Eddie's forecast performance? Okay, why profit or ROI will be more equitable for comparing? Why do you think in this question that whether you use profit or you use ROI approach, it will be more equitable for comparing the performance of Branda and Eddie? Okay, let's understand this. Now, which is the more better way, profit or investments? First is profit, because this relate to shareholders' wealth. Absolutely wrong. Are always measured to compare performances ROI. Remember. So profit, again wrong. Now there are 2 ROI factors. So one of them is correct. ROI, because it takes into consideration the fact that Mason has more investment than Arjun. Mason has more investment than Arjun. Yeah, so it can be a good indicator. ROI, because it is based on prior results. No. It is not the criteria. It is more a better measure or more equitable measure, because here we are doing comparisons even when the investments are different. So even when the investments are different, then also making this comparison, it makes it more meaningful. Okay, now next. Okay, let's do question number 3. Division X and Y are being assessed using ROI. Okay, they are being assessed using ROI as their main performance. So let's do the calculations here, guys. I have my calculator. You should also have Calci with you. The relevant information for each division is given to you. Investment required here is 100,000. Here 100,000. Expected profit is 16,000, 11,000. Current ROI is 18% and 9%. Cost of capital is given to you. Discuss whether each manager will accept the ROI, will accept the project or not. So what will you do? Just check the ROI of the project. Here ROI is 16%. How? Profit divided by investment multiplied by 100. So 16,000 divided by 100,000 multiplied by 100. Here your profit becomes 11%. Now, just see when you do the two comparisons, it's actually lower ROI, right? Even when the investment is low. Investment is same here, but the ROI for division Y is low. But now do the comparison. Division Y has existing ROI of 9%. Here the existing ROI is 18%. From the company point of view, it is more better to go for division X because the profits are high for this project. But division point of view, they would go, division Y would go for it and division X would not go for it because their existing ROI is getting lowered here if they go for the new project. Clear? So even though for the entity as a whole, division X, it would be more better to go with division X, but since we are looking into divisional performances point of view, here division Y would go for it, division X will leave. Will there be a problem with goal congruence? Absolutely yes, because it's more goal congruent to go with the project of division X since the investments are same but the returns are higher in division X. Clear? I hope now you understand this better. Now let's go for the next one. This one you can do in homework. Again, this was homework. Simple, similar questions. Right? So similar questions are in homework. Those who don't have these questions with you, I will not be sharing this PDF, so you can take a click picture of it. Okay? You can click a picture of it. And just for your understanding, I think I can give you the answers also here. So you do the calculations and you can send those answers to me on the Telegram channel and I will authenticate it over there. Right? That's a good one. So that will make you judge on your performance as well. Now, let's do question number 6. Question number 6 is on RI calculations. Yeah, so let's do this. A divisional manager is assessed by head office using RI and also uses RI when evaluating new investment projects. Company's cost of capital is 10%. Details of the new proposed project are 600,000 initial investment, project life 3 years, residual value nil. Calculate the RI for each of the 3 years using the carrying value at the start of each year as capital employed. Simple question. Let's do the calculations here. Okay. So now here, what is the first year RI? The rate is cost of capital is 10%. But I think the question is missing out on some data. The inflows are not mentioned here. Okay, just leave this question. The inflows are not mentioned. Something is incomplete here. No worries, we'll do question number 7. It's got the inflows here. ABC company is considering opening a new division to manage a new investment project. The forecast cash flows of the new project are as given below. Let's calculate RI for every year first. Okay, RI will be, now we know that depreciation is 10% per annum. Okay, and depreciation is calculated on a straight line basis and investment is given here 100,000. Okay, I will just give you the investment is, investment is given here. Investment is already given to you 5. 5 into 10% is depreciation is calculated on a straight line basis over 5 years. So 5 upon 5, every year it is 1. Every year it is 1. So your RI will be here. Your RI will be, first we have to calculate RI and both ROI. So I think I can do it here. Let's do the calculations. Right, I can do it here. First, I will do RI calculation. So RI calculation will be very simple in the first year. In the first year, it will be 1.4. Every year we will reduce 1 for depreciation. right? And we will reduce the cost of capital. Cost of capital is 10%. 10% will be 0.5, right? But we will do it on the balancing figure for the next year. So this year my RI will be 1.4 less 1.4 less, this is negative 0.1, right? It will be negative 0.1 my RI. And the next year it will be, what will be next year? So we do it on the capital, right? Your capital is 5, you will reduce depreciation of 1. So it will become 4. 4 into 10% is 0.4. So you will reduce 0.4. This is interest. How do we calculate it? We take the profits. Profits will be this. So I am doing the calculation in one step only. Profit less the cost of capital. Cost of capital is 10% of the capital employed. So capital employed is, just allow me a second. Yeah, so sorry. Okay, so now we have here, in the second year, what is your investment? Initial investment was 5 less 1 depreciation gone for year 1. The investment balance is 4. 4 into 10% is 0.4. Likewise, it will get reduced. Here it will be 0.3, 0.2 and 0.1. Now calculate your RI. So here it is 0.4 less 0.40. 0.4 less 0.3 is positive 1. Here 2 and here 3. Right? You will get your RI like this. Now the question comes in that these are the RI calculations we have done. How do you calculate ROI? It's very simple. You have the profits here, right? And you have the profit after reducing depreciation. This you divide by the investment, right? And then you get your ROI. So we can calculate ROI also here. So your year 1 ROI will be profit for year 1 is, for every year the profit is same 0.4. Here the investment is 5. Here the investment is 4. Here the investment is 3. Here the investment is 2. And here the investment is 1. So here it will be 8%. Here it will be 10%. Here it will be 13%. 0.4 divided by 3. Approximate 12 point something it will be. And 0.4 divided by 2 is 50%. And 0.4 divided by 1 is 40%. No, 0.4 divided by 2 is 20%. Sorry. Right? So we got the ROI for all the years. We got the RI also for the all years. Okay. We just had to calculate that we have done. If you have any doubts and queries, you can ask me in the chat box. Okay. Let's go to the next one. So this you can do in homework. It's a full-fledged good question. Okay. Do this in homework, question number 8. Yeah, so now we'll do some transfer pricing questions. I'm doing question number 9. A very good question. Everybody eyes on my screen. It's a very, very, very good question, guys. Okay, now, Sweet Delight Bakers, be with me. Sweet Delight Bakers specialize in making delicious cakes. The trademark fruit cake is made in Division A, the selling division, and sold to external customers for them to decorate, and or it can be enjoyed plain. It is then transferred to Division B. So Division A to B. So Division A is the selling division. Division B is the buying division, where it is iced and decorated to be sold as a wedding cake. So they're also selling to a third party. Sweet Delight Bakers are currently trying to decide what is the optimum price to sell the cakes from Division A to B. Should be in order to motivate the managers of both the divisions. The following data shows the cost incurred by Division A to make a fruit cake and by Division B to ice and decorate the wedding cake. So the variable cost and the fixed overheads are all given to you. Plain fruit cakes can be sold and purchased externally for $30. Wedding cakes can be sold for $100. Should the company make the fruit cakes internally or buy them? Let's check it. Should they bake it internally or buy them? If the company makes the fruit cake internally, If the company makes them internally, then the variable cost for division A is 20. If they buy, division B buys from outside, the cost is 30. So which is more better, to make it internally, as it is more cheaper? Okay, 20 or 30. So we will go ahead with 20 internal making. Got it? Now, what non-financial factors should also be taken into consider? I think the non-financial factors for a cake-like thing would be quality, the taste, and unchanged taste, that the customers are always loving it, the decoration, and yes, that's all. The review, the feedbacks are something that we will be looking into, right? Okay, next. What would be the implication of using the following transfer pricing policies? Now let's understand these policies. If we use a policy of full cost plus 10%, this is all from seller's point of view, right? So when we use the policy of full cost plus 10%, full cost for division A is 20 plus 8, 28. So with 28 plus 10%, it will be 28 plus 2.8, that will be 30.8. Variable cost plus 55%, variable cost is 20 plus 55%, it will be 20 into 55 is 11. 11 plus 20 is 31. Okay, now the next is variable cost only. So variable cost only will be 20 only, and external price will be 30 only. Done with your calculations. It's a 2 marker. You got 2 on 2 without any problems. And actually it's a 4 marker question. Easy? Very easy. You will never get such easy question in exam. I'm telling you. Yes, you will never get them. So come over your happiness and look here. Okay, question number. We can look into question number 10 as well. It's a good one. Let me take question number 10. Okay, and I will take one more also. Which is that question? Okay, I will find it. Okay, let's do question number 10. Everybody, eyes on my screen. It has now been identified that division A, the division A also produces excellent sponge cakes which are sold externally only. Division A can produce 100 fruit cakes per month or 80 sponge cakes per month, or any combination of the two. Fruit cake and sponge cake details are given to you. And it says selling price per unit, variable cost per unit, fixed overheads per unit. When you add variable cost and fixed cost, you will get total cost. So when you reduce it from the selling price, your profit is also given. Labor hours per cake are also given. That labor hours required to make fruit cake is 2 for one fruit cake, and one sponge cake we require 0.25 labor hours. This we would need when we calculate the contribution lost concept, opportunity cost. Okay, look here now. Advice on the determination of an appropriate transfer price and provide a reasoned recommendation of a transfer pricing policy for the transfer of fruit cakes from division A to B. Transfer of fruit cakes under the following conditions. Number one, division A has spare capacity. Okay, it has got spare capacity limited to external demand for sponge cakes. So when there is spare capacity, there is no opportunity cost. There is no opportunity cost, right? But then we need to find out what is the cost that division A would be ready to pay. Oh, I'm sorry. Okay, so we need to find out. So guys, what we need here is, in the first case, we would know what is the minimum price, because in every case we would need minimum price and maximum price. Minimum price is the variable cost. What is the variable cost of making the fruit cake? The question is of fruit cake, right? Making fruit cake is 20. What is the maximum price that the buying division would be ready to pay? Buying division would be ready to pay a price which is the external selling price, which is, I will mention here. Actually, this is a question extending from the previous one. Okay, External selling price is 30. So what is the maximum price that they're ready to pay? 30. If you know, in the previous question we had 30 as a external selling price. Okay. Now the next one. Please look at my screen very carefully. Now the next point says, question says, division A is operating. Okay, hold on. When we discuss what is the transfer price, we will say the price will fall between 20 to 30. So the price that falls between 20 to 30 is an acceptable price for both, right? Because it is not crossing the maximum price, it is not going below the minimum price. Now, division A is operating at full capacity with unsatisfied demand for sponge cakes. So what they are losing is, tell me, what contribution they are losing? Are they losing the contribution of sponge cakes, or are they losing the contribution of fruit cakes? Which contribution they are losing? Anybody in the chat box? Can you tell me they are losing the contribution of which cake? They are losing the contribution of fruit cake or sponge cake in the last point. Division A is operating at full capacity with unsatisfied external demand for sponge cake. Does it clearly tell you that they are losing the contribution of sponge cake because they are not able to, satisfy the external demand of sponge cake, so that they have to sell a fruit cake? Got it? So what is the contribution of one sponge cake? Contribution of sponge cake is 4. Right? One sponge cake contribution is 4. Clear? Absolutely. Because contribution is sales less variable cost. Now what is the contribution lost per hour? Let's calculate. Here we are losing contribution of sponge cake, which is 4. And one sponge cake takes 0.25 labor hours, right? Because it says no, that 0.25 labor hours will make one cake. So can we calculate what is the cost, what is the contribution that we are losing per hour? Let's calculate. Here I can make contribution lost per hour. Contribution lost per hour will be 4 divided by 0.25. Contribution lost per hour is 4 divided by 0.25, which is 16. Right? Because see, you are earning a contribution of 4 by incurring a labor hour of 0.25. So what contribution you will lose in 1 hour? 4 divided by 0.25. Everybody is with me on this? We are losing the contribution of sponge cake, right? Now, you know that contribution lost per hour is 16. Now, where do we divert this time? We are diverting 1 hour, the hours, towards the making of fruit cake. But can you make fruit cake in 1 hour? No. You need 2 hours to make fruit cake. So what is actually your opportunity cost here? So here your opportunity cost is to make one fruit cake, and one fruit cake will require 2 hours. For 1 hour actually you are losing $16. So for 2 hours how much you will lose? 2 into 16, which is 32. Now here if we calculate the minimum price, So my minimum price will be 32 plus 20, that is variable cost. That will be 52. Are you all with me? I'll repeat this again. How do we calculate the minimum price when we are working at full capacity? We will take into account variable cost, which is here 20, plus we will take into account the contribution that we are losing. And what you're losing contribution is not a fruit cake, because you have customers for sponge cake. So what you're losing contribution is, you are losing a contribution of 4 per sponge cake, and one sponge cake requires only 0.25 hours to make. So always convert this into number of hours, into per hour rate. So contribution per hour that you're losing is 0.4 by 0.25. 4 by 0.25, which is 16. And fruit cake requires 2 hours. So actually you're not just losing a contribution of 16. You're losing a contribution for 2 hours, which is 16 into 2, 32. Maximum price here, nothing else given, is 30 only. Okay, no, maximum price, is there anything else also given in the previous question? Let me see. No, here it is not asking you minimum maximum price, because the maximum price detail is not given. So ideally 52 and 30 will not match. So just give the answer here only, that if the company is working at full capacity, then the then the minimum pricing will be 32 plus 20, which is 52. It has to be absolutely crystal clear with everybody. So just tell me in the chat box, is this crystal clear, all folks? Because then we take up the next one. Question number 12 is homework. You don't have the question, take a pic of it. Question number 13. Question number 14th is homework. Let's do question number 13th first. Okay, very interesting question. Let's do question number 13th. Now, 13th question says division amber. Okay, there's one division which is amber, can make two products, product Y and product Z. The division's maximum capacity is 5,000 units per month. It can make 5,000 Y or 5,000 Z or any mix. Selling price, variable cost, extra cost. Remember, when we calculate the net selling price, we need that extra cost. So extra cost when it is sold externally by the customer or to the customer is extra selling price. Extra cost if sold externally is this. Contribution when sold externally is 2 and 4. Okay, contribution if it is sold externally. Now, please look here. Determine which product division Amber would be making to maximize contribution and calculate the monthly contribution. It's a simple question, the kinds that we have done already earlier. Right? We have to take what is the maximum contribution per unit. So, maximum contribution per unit is 3 here, and here it is 4. So obviously it is better if they make Z, because it is giving them more contribution per unit of $4. Okay, so we will say product Z here. Division Azure asks Amber to supply 1,000 units of product Y monthly. Determine the minimum transfer price which will be acceptable to Amber. Now, it is asking them to transfer at a price of 1,000 monthly. What is the, see, now they are operating at maximum capacity, no spare capacity. Question has given you the hint, like I said. Now, how would you calculate it? What is the formula? We use the formula here. Okay, we will use the formula here. Variable cost plus opportunity cost, right? What is variable cost to make product Y? Variable cost to make product Y is $9. Done. Now, what is the opportunity that they are losing? If they are making product Y, not making product Z, they are losing the contribution of product Z, correct? Yes, very good. So what they are losing? They are losing a contribution of 4. So always take the contribution that you're losing, that you're giving away, that is just going away from you. 4. So that's like your ex-girlfriend that is going away from you. Remember that is an opportunity cost. Okay, so that is 13. So now 13 becomes your minimum price below which not the division would not be ready to sell. Okay, next. As your shares that can buy product Y externally from the market at 11 per unit will not pay more than that. Explain what would happen if both divisions are autonomous, that means independent, and whether the benefits from the company as a whole or not. So we will calculate the minimum price and the maximum price. Okay, now what is the minimum price here? 13. What is the maximum price? See, if they buy externally from the supplier, it's 11. So we will take 11, or external price if they're selling extra cost, if they sell externally is $1, contribution that they earn is $4, right, when they sell it externally, right? I hope you're with me. For that I need external selling price. Nothing is given for the external selling price. Oh, so there is a net benefit of $3. Should we say that? Yes, it will be more by $3. That means we always take lower of the price, right? It will be more by $3. Nothing is given, but we can make this understanding, right? So therefore, we will take minimum price of 11 only because we'll take lower of the two. So we will take lower of the two 11, and minimum price is 13 for selling division. But division B is only ready to buy maximum till 11. So now here there is no goal congruence, so this transaction may not happen, right? So then internally they will not be ready to buy, they will only buy it from outside, right? So I hope it is clear. And as it is more cheaper to buy it from outside because it is $2 cheaper, right? Now let's go to the next one. I'll take question number 11, the last question for today. To understand this transfer pricing even more better way, it's got multiple parts, and let's just look at these questions. So be with me on question number 11. Now, Sunrise Manufacturing produces 3 products, A, B, and C. Each product has an external market, but product B can also be transferred internally to division Y. After incurring extra cost of $60, division Y sells the transferred unit for $300. So B will transfer to Y. Y has an external price of 300. No, and it will incur, after incurring cost of 60, it will transfer the unit for 300. Maximum quantity that will be required for transfer is 150 units of B. Details of the 3 products are given to you. Selling price per unit, variable cost per unit, labor hours needed per unit, maximum units that can be sold externally 2000, 1250 and 2400. In the period under review, division X has only 20,000 labor hours available, which is not enough to meet the full external demand. Okay, applying limiting factor analysis already done. The optimum production plan is given to you. Product A is giving you a contribution of 64 per unit. Labor hours are 4. So contribution per hour is 16 here, 17.5 and 19. Accordingly, ranking is done. First, you will make product C, then B, then A. Optimum production plan is that is also made for you. So it's all ready made and it's all readily available for you. Okay, and it's all made to you. Optimum production plan is also given to you. Product C, you will be making 2400 units of it. Product B, 1250 units. Product A, 1325 units. Okay. Clear? Now, what is the question asking? The division X is working at full capacity. What are the minimum and maximum transfer prices for product B? Product B, remember, is a selling division. Okay. And product Y is a buying division. So, okay, there's this one question. So, we have to just set the minimum and the maximum price. Very good question. It is just going to complete the, every scenario that we have discussed here for the opportunity cost is covered here. So, let's cover this question in entirety. Okay. Now, what is the minimum price, guys? It's very simple. Now, we know about the opportunity cost also. So, here I will just do the calculation. Minimum price is what? Repeat with me. Variable cost plus opportunity cost. Very good. What is the variable cost given here? Variable cost for division B is 95 given to you. Okay, and we require labor hours per unit 6. But we are transferring it to division Y. How much labor hours division? Okay, yes, wait. Okay, now here the variable cost is 95. We have to transfer this product, but then, if I have to transfer it, if you look here, C is the one which is most contribution generating product, correct? Now, if I'm transferring division, if I'm transferring product B, and if it is being transferred to division Y, and we would need 150 units of product B. Okay, as per the optimum production plan, how many units of product B we are making? We are making a product B 1250 units. What is the maximum capacity? 1250 units only. Right? Now, if you look here, what is, we require 6 hours. Right? So, we'll be transferring 6 hours. But what contribution are we losing? Are we losing the contribution of product B? That is 17.5. See, it's already working at full capacity, right? And if I make more of product B, I will make less of product A. If we make more of product B, I will be making less of product A, correct? See here, the optimum production plan is given to you. Product C 2400 units, product B 1250 units, and product A 1325 units. If you make more, if you will transfer product B over there, you're not losing a contribution per hour 17.5, but you're losing a contribution of 16. Because then you will make less of product A, right? Because product A is a balancing figure. So you would be transferring 6 labor hours of product B. Wait. There is some. Yes. Product B requires 6 labor hours only. Sorry, I thought that I'm looking at it wrong figure. Yeah, so product B requires 6 labor hours. The contribution that you're losing is not 17.5 because that you are getting. Product A has got the balancing figure, so we will make less of product A. Correct? So what we are losing is 16 per hour because we will make less of product A. So now what is the minimum price? Opportunity cost here will be 6 into 16. So minimum price will be then 6 into 16 is 96 plus 95. Your opportunity cost here will be 191. Sorry, the minimum price will be 191. Are you with me on this? I will repeat this point again. It's a bit complex point. See here the question says that the optimum production plan is already given to you. The maximum demand is also given to you. We are having limiting factor here. So that is also embedded here. Now the question says if you have to transfer product B. Okay, if product B can be transferred internally to division Y, maximum product B demand is 1250 that if we meet, and then we transfer product B to division Y also, we would be needing to make more of product B than if we have already made to the full capacity. See, 1250 is the maximum capacity, is the maximum units that can be sold, and here also we're selling full 1250. So we are meeting the external demand, but what then we will be sacrificing will be the last one, product A. We will make less of product A. If I'm making less of product A, I'm losing a contribution of product A, which is 16 per hour. So if you're utilizing this for 6 hours of product B, then the contribution you're losing is 6 hours of product B multiplying the contribution that you're losing. And you are losing a contribution of 16. That goes to make one unit, goes to make product A. Clear? Because then if you're making more of B, you're making less of A. Simple. You're just utilizing the time like that. Clear? So here your minimum price will be 191. Now let's look at the maximum price. Maximum price will be lower of, what is the price at which you can buy this product from the market? Okay, we have to look into what is the price at which we can buy it from the market. So division Y can buy it from the market at a price of external selling price. Nothing is given. So external selling price, which is 200. Or what is the price at which it can be sold in the market? It is given here, 300. And after incurring the cost of 60, then division Y sells a transfer unit of 300. No, there is a cost to be incurred. So 300 minus 60 we will take. It is basically saying that the price is 300, but it can only sell it to a third party only when they incur an additional cost of 60. So for them, the price then becomes 240. Now, which is lower of the two? 200. So my answer is minimum price is 191 and maximum is 200. Answer is A and not C. And not D and not B, of course. Okay? Are we absolutely crystal clear on it? Any questions, any doubts? So it's a very good and a very complex question that required that in basically had an input of even the limiting factors and constraints were there, but applying that also we're able to understand this. So I hope now everybody is absolutely crystal clear. If you have any doubts, please ask me in the chat box. Put it in your queries, and I'm sure you have enjoyed your live session. And guys, if you have not subscribed to the channel, do subscribe it, because you may not be having the ROI that you desire then on the investment that you're doing is of knowledge. So do subscribe the channel so that you have not wasting and basically you're not losing on any videos that will also be coming up and uploaded here. Very useful material. Subscribe to my channel, subscribe to my Telegram channel also, where I frequently update a lot of things, lot of new strategies that we adopt. And you can connect with me on WhatsApp also for any queries and questions that you have, and I'll be very happy to solve. Okay, so that's all. Any questions, any queries? I'm waiting for next 10 seconds. Ask me, else we'll be just winding up the session. So guys, but by the time that you're putting up the queries, I think let's take 30 seconds and let's quickly rewind what we have covered. So today we covered the topics like ROI and RI as well as transfer pricing. And so if someone asks you, let's say tomorrow, what is the difference between ROI and RI? What would be your answer? If you want, you can type it in the chat box. But I think it should be handleable for you when something or in your mind only ask you, what is the difference between ROI and RI? What is more advantageous? How do we fix the transfer price? How do we do the opportunity cost? So I mean, you should be able to handle it. And see, why I took this session live in class today, or live for everybody on YouTube today, because this is the topic where a lot of students lose marks. And, they, because we always carry an assumption that I know everything, every minute detail counts in the exam, right? So I hope it was very exciting for you to join today, to understand, to have 100% crystal clarity. And I really cannot wait to come up with a new topic with all of you again for another live session. Till then, keep studying, and keep enjoying. Keep watching the videos that I've uploaded on my channel, including the revision and the marathon videos as well. And remember that please make a concrete promise to yourself that you're going to study harder and achieve high marks. And if you think that this session today has helped you really, please don't forget to click on the subscription button and turn on the bell option. Okay, so unlike the divisional managers that keep chasing the ROI, and make sure that your ROI is always moving upwards, it's never going downwards. Okay, and I'm sure that this decision will never have a zero downside ROI for you. On this note, see you, bye bye, take care, have a good day.